entered a new paradigm of decision-making. We'll explore these questions with Richard Thaler, one of the founding fathers of behavioral economics, next.
And let's look at where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by.
Thanks so much, Joe. And heading into the close, we're looking at what we've been looking at most of the day for the major U.S. averages here in the U.S., and that is mixed trading. That being said, we do have the Dow holding on to a very small gain, one that puts the Dow on pace for its sixth record close in a row. Quite a winning streak. The S&P 500 and the NASDAQ, though, really lagging. Let's really focus in on this Dow strength, though, helping the Dow higher today to this potential sixth record high, closing high, Johnson & Johnson. This as Barron's did have a bullish mention saying that Johnson & Johnson could climb by 20% from current levels. In fact, Johnson & Johnson is having its best day since the election. Pfizer is also higher after the company did raise its quarterly dividend on an annual basis. This equals $1.28 per share, up 6% from where it had been. And then finally, ExxonMobil trading nicely higher in sympathy with oil. Oil levels last seen of July of 2015 as both OPEC and non-OPEC members have agreed to cut supplies and really help the oil price. As for whether or not these record highs for the Dow can continue, are the markets frothy? Is it overbought? Let's hop into the Bloomberg and take a look at hashtag BTV 3505. This is a one-year chart of the Dow. On top, we see the Dow trading nicely higher. In fact, right now up about 13% on the year, on pace for its best year since 2013. On the bottom of the chart, though, we have the Dow's RSI, or the Relative Strength Index. This is a momentum indicator, and typically when it goes above 70, many investors and strategists use that as an indication to sell. We see that the Dow is above that 70 mark. It has been there for the longest stretch over the last year. In fact, the Dow's RSI is at its highest level since 1996, so basically in 20 years. Interestingly, though, Jonathan Krinsky, the head of technical analysis over at MKM, he's saying that overbought doesn't mean over, and he has a point. The Dow, of course, climbed quite a bit since that last high back in 1996, right into the 2000 peak. So it'll be interesting to see whether this turns out to be a sell signal or just a cautionary tale of caution. Scarlett and Joe.
Thanks, Abigail.
All right, we have some breaking news on Viacom. It is official. The company is saying that it has stopped the exploration of a potential combination with CBS, and it has named Bob Bakish as permanent CEO. He was acting as the interim CEO, but he is now the permanent CEO. Of course, Viacom, the owner of MTV, Nickelodeon, and Comedy Central, was looking to be reunited with CBS under Shari Redstone's proposed merger of the company. Shari Redstone and her family do have a controlling stake in both Viacom and CBS. You can see their Viacom shares have been tumbling all day, down more than 9%. What'd you miss? A recent surge in consumer confidence is largely due to Americans' initial reactions to President-elect Donald Trump's presidential victory. In the latest University of Michigan survey, there were some exceptions to the optimism, mainly among those with a college degree and among residents of the Northeast, reinforcing the extent of the divide in the country. Joining us now is Richard Thaler, who studies behavioral economics and finance at the University of Chicago Booth School of Business. Thank you so much for joining us, Professor. We see it in the financial markets. We see it in the reactions to domestic policy, foreign policy. What makes people so convinced suddenly of the upside, the potential upside, give the benefit of the doubt, when there are no specifics given yet on any of the policy prescriptions out there?
Well, I think anyone who's trying to put logic into anything that's happened in the last 6 months or so in elections is going to have a hard time. Both Brexit and the Trump election, people seem to be just voting against their self-interest.
From a behavioral standpoint, is there a reason why, in the absence of any real details about what Trump is going to do, or even how Brexit is going to affect the U.S. economy or the U.K. economy, that people start telling a positive story? We hear all kinds of stuff, fiscal stimulus and deregulation, even though Trump hasn't really talked much about that. People nonetheless have really glommed on to this fairly positive story without any of the negative sides. What makes us do that?
Well, people suffer from something called the confirmation bias, which is they seek evidence that's consistent with their beliefs, and they go out and look for it. So if you'd like to think that the market is going to go up and the economy is going to be great, then you'll latch on to any bit of information that may support that, regardless of where it comes from.
So going off on that a little bit, to continue that idea, how do we explain the behavior of people who understand that their choices are against their better economic interests, but do so anyway as a way to send a message? They're cutting off their nose to spite their faces. Why would they continue doing that? How do we explain that kind of action? Well,
one way of thinking about this is it's kind of like when you have an itch. You get a mosquito bite or poison ivy. What do they tell you to do? Don't scratch it. What do we all do? We scratch it. So this is just human nature. And that's the way people are acting these days. They got an itch, and they're going to say no. And they're going to just reject the status quo because they're angry or because things haven't been going well for them recently, and vote for something else. Be it leaving the EU or voting for the non-status quo candidate. And the beliefs of many of these voters just have nothing to do with reality. I saw an interview with one Trump voter who said she was voting for Trump because Obama had ruined the economy, the unemployment rate was very high, inflation rate was high, and the dollar was weak. Now, if those are your beliefs, I don't know where you're getting them.
Are there certain conditions which arise in a society in which people might be more inclined to cast a vote that's more, sort of burn it all down and start over? I mean, obviously, normally we have elections and someone representing the sort of status quo and the sort of existing norms of politics. Usually someone like that emerges as a winner. In this case, is someone who appears to be very different than the status quo and someone who clearly flouted the norms that we have for how to run an election. Is this a fluke? Could this happen any time, or are there certain conditions that make it more fertile?
Well, it's never happened before, and we can hope it never happens again. But I think it's fair to say that people are acting emotionally, and we do a lot of stupid things when we're emotional. It's really all as deep as we need to go. If somebody insults you, you're likely to say something you'll later regret, and people may someday regret some of the votes they've made. As
you've been saying, and as a lot of people say, there's a certain level of seeming irrationality or seeming like President Donald Trump can't deliver on what people want to deliver, or maybe they have a misconception, as in the example that you cited, about the current state of the economy. But is it also possible that economics just is not equipped to understand actually what motivates the voters, and that maybe people have deeper interests and deeper anxieties that traditional measures can't really get at yet?
Oh, I mean, look, economists aren't very good at understanding the psychology of voters. Actually, very few people are. But what's curious is I think we've seen a big decline in the value of expertise, and that would include the three of us. Mm-hmm. So the media and the talking heads you bring on, people don't put much stock in what we're saying anymore. And so I put some of the blame for this, if we're going to call it blame, on the chattering classes we haven't gotten through. No, you bring up a really good point. I want to go back to the emotion part of it, because
it seems like the emotional response can be fairly contagious, infectious even. We've seen Brexit already. We've seen the U.S. presidential election. We've seen the Italian referendum. We have elections in Europe next year. What might give people pause next year to hold back on the emotion and vote more logically? Or is it a case where you've got a couple of polls that are voted in favor of the emotion, so people continue to run with it until it plays itself out?
You know, I think it is true that Brexit and Trump are very much the same phenomenon, but it's not that Trump voters. You know, I'm guessing most Trump voters would have no idea what Brexit even was. So it's not that they got carried up in some wave that started in England, as much as the working classes have been losing ground for the last 30 years, and they're angry about it. And that same phenomenon is happening in various places around the world. Of course, you know, everything matters, and we know this. I think it would be wrong to overinterpret this election. After all, you know, 100,000 votes going a different way, and we would all be talking about how Trump lost and how could anybody have ever thought he would win. So, yes, it's a shocking result, and his behavior since the election has made it more shocking. But we have to remember that more people voted for his opponent than for him.
All right, good points. Richard Thaler from the University of Chicago Booth School of Business, thank you so much for joining us. Richard Thaler, of course, one of the founding fathers of behavioral economics. Coming up, BP Capital Chairman T. Boone Pickens gives us his take on President-elect Donald Trump's anticipated selection of ExxonMobil CEO Rex Tillerson as the next Secretary of State. This is Bloomberg. Billionaire energy investor T. Boone Pickens is applauding the potential selection of Exxon's CEO Rex Tillerson as Secretary of State. Mr. Pickens calls the selection perfect. And he writes in a statement, roughly 2/3 of the world's oil is controlled by state-owned oil companies. So politically, he's well skilled for the position. And those are the very nations America has keen interest in for economic and national security reasons. Mr. Pickens joins us now on the phone. Mr. Pickens, thank you so much for taking the time. My first question to you is, have you been in touch with Rex Tillerson or the campaign and have the confidence that he will indeed be named Secretary of State?
Well, I know Rex, and I'm not in touch with this decision on Secretary of State, other than through the TV and other news media. But I know Rex, and I've known him for years, and great addition to the cabinet.
Mr. Pickens, as you mentioned, obviously, many of the hottest geopolitical spots in the world are oil nations. So from that perspective, Rex Tillerson would have, great insight. On the other hand, perhaps the interests of the energy industry are different from what the interests of the U.S. would be overall geopolitically, perhaps as it pertains to security and human rights and other things like that. Are you confident that Rex Tillerson would be able to separate the interests of the country from the interests of oil?
Yes, I would. Tillerson is, he's a major oil company guy, but he's had so much experience, and he's a good man. He's worked with Boy Scouts and different organizations and all. No, I would have no question about Tillerson being a good Secretary of State. He's a good man. He's a hardworking guy, and he knows the world. Exxon operates around the world, and I would think he'd be an excellent choice.
That may be the case, but to follow on Joe's question, how does Rex Tillerson ensure that there isn't conflation between the U.S.'s diplomatic interests, its geopolitical interests, and the energy industry's business interests?
How does he assure us that he would not have a conflict? No, Tillerson. He's a worldwide personality, and to go from CEO of Exxon, I mean, he's leaving Exxon. He's off to a different part of his life, and he would go to Secretary of State, and he would perform that function just like he would if he was at Exxon. I mean, don't confuse me that he's going to make a decision for Exxon for no. I mean, he would be working for the United States government and doing everything he could to be sure our business would go forward and be well executed. So no, I think Tillerson would be great for the job.
Obviously, this potential name has come under a lot of criticism. I think probably part of it is the fact that he is an oil CEO, the industry inherently being political, but also due to his perceived relationship with Vladimir Putin. We have a story just out on the Bloomberg about how Rex Tillerson frequently went to the White House regarding the Russia sanctions, wanting to make sure competitors wouldn't gain an edge through it. He is considered to be a friend of Putin and, very close. Given that Trump is already sort of under fire for perhaps, on all this stuff about the hacking, is this going to create a headache for Trump? The idea of having a Secretary of State that furthers the idea that this White House would be more favorable to Russian interests?
Well, the hacking, I hate to tell you all this, but I don't even know anything about how to hack anything. So but no, Tillerson, I think he'd be great. He knows Putin, so he could sit down and talk to him about things. He's not about to make some foolish deal, of course. And I can't emphasize this more. When Tillerson leaves Exxon and goes with the State Department. He is 100% State Department. Exxon's got plenty of people to run Exxon. They don't need another CEO. They've got a CEO in waiting. So he will. I mean, he will go to the to all lengths to be the very best Secretary of State the United States has ever had.
I'm glad you bring up ExxonMobil here, because I wonder what your thoughts are, if you have any, on ExxonMobil's president, Darren Woods, who would be the heir apparent to Rex Tillerson. I mean, if the company has a CEO in waiting, is he the CEO in waiting?
Is he? You say the CEO in waiting?
Is Darren Woods, the president of ExxonMobil, the CEO in waiting, the one who would then succeed Rex Tillerson?
I don't know who's going to succeed Tillerson. I know this. Don't worry about Exxon. They've got plenty of executives, qualified, good CEOs that are available there, and no question about it. And so he will, the day he leaves and goes to work for the State Department, he will be 100% for the government. He's not working for Exxon anymore.
I want to switch gears and talk about OPEC. Oil is surging today on news that the organization seems to be getting it together, has not only willing to cut, but cut more than expected. How confident are you that OPEC will be able to execute on what it's announced? Do you think they'll be able to go for a while without cheating and boost the price of oil from here?
No, listen, I'm long oil, so I think it's they want more for their oil, and they have said what they're going to do, and they will carry out what they say they'll do. They will cut supply, and the price of oil will come up. I mean, it's the producers of oil, whether they be OPEC, the Russians, whether it's the oil and gas industry in the United States, have all had enough, and so you will be at $60 a barrel within 30 days.
$60 a barrel in 30 days, that's your forecast, as long as OPEC abides by the production cuts that they've agreed to?
Yes. I think that you will have those cuts, and you will see January of next year, you'll be up $60 a barrel.
What about much higher than that? I mean, I feel like we've completely discounted the ideas that we're going to see, say, triple-digit oil per barrel, dollars per barrel anytime soon. Is it plausible that we could get back there? What do you see for 2017, 2018, and beyond? Okay,
take me up to 2018. You got a chance, but you aren't going to have $100 oil in 17. But I do think you can have $75 oil in 17.
But there have been a lot of instances where OPEC hasn't been able to comply with production cuts that they have set out in the past. Do you expect there to be wobbles along the way, instances where they can't quite commit to what they have promised? What might those look like?
Well, you're saying that they won't stick with the deal.
Correct.
I believe they will stick with the deal. I think it's going to happen. And when you look, I mean, the Russians need money. OPEC needs money. And I think they will stick with the deal. The Saudis have said they will cut below 10 million a day. So they're cutting out 1 million barrels a day. So they have to be the biggest one to do it. When they perform, when they show the leadership, and they will, that the other countries will come along.
Real quickly, some of these skeptics of this deal, including Goldman Sachs, have argued that, if prices go up, that U.S. supply of oil can just come on quickly and depress prices overall. How quickly can U.S. production react to any price increase?
Well, let me tell you, I know the oil field. You know that. And I can tell you, it will not come on fast, because the people that worked in the oil field, they now have other jobs. And so it is, women run the oil field. They tell their husband, look, you get a job. No, I'll go back to work when the rig goes back to work. No, you get a job. You're not going to hang around the house. I'm telling you the truth. I know exactly what. And those guys have got jobs.
Okay.
And all right, you got it.
Mr. Pickens, we've got to leave it there. Thank you for your time. We really appreciate it. T. Boone Pickens, Chairman and CEO of VP Capital. This is Bloomberg. We're moments away from the closing bell. What'd you miss? Another record day for the Dow and the S&P 500 hovering near an all-time high, while small caps are retreating. Oil jumping by more than 3%, also sparking a bond sell-off. All of this ahead of Wednesday's Fed decision. I'm Scarlett Fu.
And I'm Joe Weisenthal. We want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. The Dow closes at a record high again for the S&P 500, which is down by about 2 points, barely lower here. This is the worst day since December 1st. Pretty hard to believe. And crude oil, really the star mover, I suppose, if you want to point one out. It's gained more than 1.5%, although it did gain a lot more.
Higher,
exactly, and it paired some of its advance to close.
Yeah, another Dow record high, sort of returned to the norm here with the Dow rallying and the NASDAQ selling off.
All right, in terms of the actual stocks to pay attention to, it kind of started off in Asia overnight. And I bring this up because you see a lot of red arrows there. Stocks across Greater China mainland, Taiwan, Hong Kong, they all fell as China took a much stronger tone in warning Donald Trump not to use the one China policy as a bargaining chip in trade discussions. Jamie Metzel of Atlantic Council, if you'll remember, Joe, told us that Beijing cares more about Taiwan and the one China policy policy than the Sino-U.S. relationship. FXI I also included there at the end. It's the ETF that tracks Chinese stocks in New York trading, down 2.4%. Energy stocks, also big movers here as oil prices rose. They rallied in the early part of the session, but faded some of their gains as oil paired its advance. For the XLE, which is the Energy Select Sector Spider ETF, that is at its highest since last June. And you can see that ConocoPhillips, Marathon, and Exxon all up by better than 1%.
Let's look at government bonds. Not much action in the U.S. side. Yields just marginally higher, both the 2-year and the 10-year, both up a little bit. But let's take a look at the Chinese 10-year. A pretty significant jump. We hardly ever talk about Chinese government bonds. It's just not discussed very much. But let's take a look at this. This is a 1-year chart of 10-year yields in China, really having shot up a lot lately. And so this represents a sort of another form of tightening. You mentioned the equity sell-off last night in China. It wasn't just combined to that. It was also bond yields. So might be something you want to keep your eye on right there.
All Chinese assets. And in fact, we'll talk about this a little bit later with David Wu of Bank of America Merrill Lynch. Let's move on to currencies here, where oil exporting currencies rising in value versus the dollar. The ruble at its strongest since July of 2015. You could see there also the Mexican peso, even with today's decline against in the dollar versus the peso. The Mexican peso is still down about 9% since the U.S. election. A quick check also on the Turkish lira, depreciating for a third day. There are a number of concerns here on Turkey. Weak data. You had the economy contracting in the third quarter. Also increased political risk because there were a pair of bombings in Istanbul on Saturday that killed more than 40 people. And, of course, the backdrop of oil rising. That's bad news for Turkey, which imports its oil.
And on commodities, speaking of oil, that's obviously the big one, up 1.7%. It had been up quite a bit higher earlier in the day on this news of deeper cuts from oil-producing countries than had been expected.
Up as much as 5.8% to 54.51.
Really much bigger earlier. Gold up marginally, and steel up 0.8, had been higher, but that's also, keeping an eye on those industrial metals. I want to take a look at a 1-year chart of oil just to give you sort of the perspective here. What a monster year, up 46% over in the last year. But what's really remarkable here is how low we were earlier in the year. We started the year with like a 29% plunge in just the first couple months of oil, then have really come surging back, actually more than double since the bottom. So it has been quite a year for oil.
Pretty remarkable moves there. Okay, well, what'd you miss? Oh, those are today's market minutes. I was so excited to get to what'd you miss. What'd you miss? Before Donald Trump was elected, many strategists and analysts said that if he would win, the markets would tank, the economy would head into recession. One person who disagreed, one contrarian, was David Wu. He is Global Rates and Currencies Research Head at Bank of America Merrill Lynch, and he joins us now.
David Wu, great to have you on set. I think of all the strategists, your sort of post-election forecast, especially in the event of a Donald Trump victory, was closest to being correct. Most people saw doom and gloom. I want to go into this chart. It's a look at the Bank of America Merrill Lynch multi-asset strategy 2x leverage index, basically a risk parity index that has a big sort of bond component, really underperformed. And in my view, even more than the equity rally, the defining aspect of this post-election period has been the sell-off and the failure of diversified portfolios. You called the potential for higher growth, higher inflation if Donald Trump won. That certainly seems to be the expectations. How much further can we see these moves play out?
Personally, I think there's probably still some room for these trades to continue. Because the honest truth is, think about this, right? I mean, Trump said he wanted 4% GDP, right? Mnuchin said he wanted 3 to 4%. And yet you look at consensus forecasts, for 2017 it's at 2.2%. For 2018 it's 2.2%. Now it's where there's a huge perception gap. I'm still very much, most clients I talk to, people are worried about, well, listen, maybe these tax cuts are going to get saved rather than spent. People are worried that, at this very late stage of the business cycle, all you're going to get is inflation rather than growth.
Right.
But I think, honestly, people are finding excuses for why they don't have the trades on. Because I think the bottom line here is this. You cannot just look at this as pure fiscal stimulus. You got to look at this as a cocktail of measures that are designed to boost confidence, okay, to free up the animal spirits, okay? And I think this is also going to be about easing access to credit, okay, because there's no question that the, Dodd-Frank is going to be a very important part of the deregulation, basically, attempt. I think this is about essentially unshocking the U.S. economy for it to do what it does best, which is to take risk, invest, and grow.
So what will this next stage of the rotation look like? If there's still room to go, what will it look like in the next stage versus what we already saw?
Right. I think that's an excellent question. I'm of the view that, you know what, if you look at basically, for example, the sell-off in rates, right? Much of the sell-off in rates has happened in the back end, like 10-year, 30-year. And much of the sell-off has been driven by a repricing of the inflation expectations. Break-evens, 10-year break-evens now back at 2%. At 2%, you know, I have no qualms because I think 2% is probably fair. Where I think the market potentially still has yet to reprice, for example, the rates market, is the belly of the curve. I mean, think about this. The market is still only pricing in, you know, less than 2 hikes for next year for the Fed. The market is only pricing in less than 2 hikes for 2018. Now it's inconsistent with a 3% plus GDP when unemployment is at 4.6%. So I think from that point of view, the market, as long as the market is still pricing below the Fed's own dots, forget about any revision in those dots, I think that means that rates definitely have more upside to go. And I think anything that's linked to rates have more upside to go.
You know what's funny? Listening to you say that Donald Trump is going to bring with him a whole cocktail of reforms kind of reminds me of Shinzo Abe and all the different arrows of Abenomics, the fiscal, the monetary, deregulations, a sort of national greatness message, getting people excited about the Japanese economy. I think the verdict on Abenomics is mixed at best. Do you think that this cocktail, as you put it, will actually translate? Why will it translate effectively?
Joe, first of all, you know what? You know, yes, now looking back at Abenomics, it's, oh, wow, you know, this thing's sort of lost momentum. It hasn't worked out well. But you know what? In the first 3 months of Abenomics, the first 6 months, the first 12 months, that's all people talked about. I think going back to the last 5 years, I think that was the only year hedge fund investors actually made honest money was in 2013, trading Abenomics, Nikkei, Dolly, and so on and so forth. I think the point is that we're only like 1 month after the U.S. election. This trade has a long way to go, at least up to, let's say, the inauguration day. I personally think a lot of the Trump trade is going to get priced in already by January 20th. But nevertheless, this is sort of like a buy the rumor phase. But nevertheless, you remember Abe, much like Trump, right? Abe actually, when he won in December 2012, he did not control the upper house. Right. That's why he said, well, I need to basically really boost GDP growth so I can basically pick up the upper house so that I can basically change the Constitution. The same thing with the Republicans. For them to do what they said that they really want to do, which is to repeal Obamacare, they actually haven't got enough seats in the Senate to get that done. They only got 52. They need 60 to prevent filibuster. So from that point of view, again, much like Abe, they need to boost growth between now and the midterm election of 2018 so they can pick up another 8 more seats in the Senate. So from that point of view, the political pieces are very, very similar between now and basically Japan, beginning of 2013.
That's an interesting analogy, but I want to go back to some of your clients' questions about, are we too late in this economic cycle? That may be the case that they didn't have their trade put on correctly, but it is a valid point nonetheless. This has been the longest running expansion, I believe, in post-war history. I mean, how much further can it go? I know people say that bull markets don't die of old age, but it has gone on for a long time, and you could argue that it's starting to peter out, or it was before this election result.
I mean, Scarlett, you may be right, but what I would say is this, you know, investors cannot be talking from both sides of their mouth, right? Only a month ago, the day before the election, the market was pricing practically no hikes for all next year because they saw, well, even the economy grows at 2%. There's no way the Fed is going to be able to hike because we've got all this, I mean, underemployment in the economy and all this hidden unemployment. And then what, a month later? All of a sudden, people are worried about where like full employment and then inflation is going to go through the roof. I think, you know, the honest truth is this is where I've got an intellectual inconsistency problem. We could talk about. I think where people are getting it wrong is that people are much too focused on the infrastructure, you know, basically piece. Everybody say, oh, well, fiscal stimulus equals infrastructure spending equals more copper, more tractor. This is why, like, copper prices gone through the roof, Caterpillar prices gone through the roof. But the truth is, I think, you know, the infrastructure piece probably is going to be the last piece to get through. Because, you know, one thing is for Trump to go to the Tea Party and say, we're going to blow up the deficit because we're going to cut taxes. Another thing is to say, well, we're going to blow up the deficit because we're going to do infrastructure spending. I think infrastructure spending is probably going to be the last piece to get through. Even if it were to get through, think about it. If you want to build a bridge, you got to have a bridge to build. Right. So I think the earliest you're going to see anything like that is going to be late 2017, maybe early 2018. So I'm not that worried about this inflation running amok. Commodity prices, this is why, you know, I'm more worried about Chinese housing going to slow before U.S. based construction spending starts to pick up.
You mentioned that a lot of the skepticism of your thesis you think is caused by the fact that people just don't have the trade on, or they were caught really offsides. And I mean, we know that, you know, the people were wildly bullish on bonds throughout much of the year. Even within stocks, they like the bond proxies. How far offsides are investors still, given the move we've already had?
I would say definitely the hedge fund community is definitely has been well positioned. I think not that they had a position on going into the election, but definitely since then, I think they get the point. They've been going after this. We just said Abeconomics provide a great movie script. Right. I think a lot of the real money clients, you know, the mutual funds, I mean, I think they're still looking to take advantage of any basically dip in bonds to actually increase duration. I think those are the guys who are still in denial, who have yet to basically play catch up.
All right, David Wu, Global Rates and Currencies Research at Bank of America Merrill Lynch. You're sticking with us because we're going to talk Trump's geopolitical agenda with China and how it's exacerbating relations with our largest trade partner.
And some breaking news here. I want to pass some headlines along. Boeing planning a deeper cut in production next year for the 777 jetliner, which is the company's second biggest source of profit. Boeing plans to slow output of its largest twin-engine model to 5 aircraft a month starting in August of 2017. That is a drop from a previously announced cut to a 7-jet monthly rate that takes effect early next year. Boeing shares trading marginally lower in after hours, trading down 0.6%. This is Bloomberg.
I'm Nina Melendez. Let's get to First Word News this afternoon. It's official. Goldman Sachs President Gary Cohn, once the heir apparent to CEO Lloyd Blankfein, has accepted the job as Chief Economic Policy Advisor for President-elect Donald Trump. That's according to the Trump transition team. Cohn has spent more than 25 years at the investment bank. And Trump is eyeing former presidential rival Carly Fiorina for Director of National Intelligence. That's according to a report by the New York Times. Trump met with the former Hewlett-Packard CEO today in New York.
We talked about the opportunity that the president-elect has to literally reset things, to reset the trajectory of this economy, to reset the role of government, to reset America's role in the world and how we're perceived in the world. And I think it's why he's getting such fantastic people in his administration.
Trump is meeting with another former presidential primary rival today as well, former Texas Governor Rick Perry. He's reportedly a candidate for Energy Secretary. And Electoral College members have requested a briefing on Russian interference in the U.S. election. 9 Democrats and 1 Republican sent a letter to James Clapper, the Director of National Intelligence. The electors say they are concerned about Donald Trump's disregard of the intelligence community's conclusions about the hacking. They're also concerned about Trump's continuing defense of Russian President Vladimir Putin. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nina Melendez. This is Bloomberg.
What do you miss? U.S. President-elect Donald Trump has upped the ante with Beijing by saying he'll use the One China policy as a bargaining chip to get a better trade deal. All 3 asset classes in China fell overnight, stocks, bonds, and the yuan. Still with us is David Wu, Global Rates and Currencies Research at Bank of America Merrill Lynch. David Wu, thank you for staying with us. So the first thing that Donald Trump has truly done is just totally turned over the table on China, being very explicit that the One China policy is not sacrosanct, that he wants to use that as a bargaining chip. How does this play out? What do you see as being some of the next steps here?
This is my single biggest worry for 2007. I mean, otherwise, I'm pretty bullish about the world outlook for 2007, except that I fear the U.S. and China could be on a collision course. And it's almost making the case. Why do I say this? Think about it. Trump has 2 major policy pillars, fiscal policy and trade policy. His fiscal stimulus is going to be definitely bullish for the U.S. dollar. But for his trade policy, which is to bring jobs back to the U.S., he actually needs a weak dollar. So does he want a strong dollar? Does he want a weak dollar? There lies the biggest contradiction of his entire policy mix, right? Now, I think he's going to ultimately want a weak dollar. The problem is that China also needs a weak RMB. So how can China and Trump both have weak currencies? Think about it. The biggest irony is like this, right? The more successful Trump is going to be, meaning the stronger is the U.S. economy, the stronger is going to be the dollar, which means the weaker the RMB, which are only going to increase the pressure on Trump to label China as a currency manipulator.
Right.
Right? So from that point of view, it's almost self-fulfilling. It's already baking the cake. That's what I worry most about. And how it plays out, I think this is going to be the biggest headache for investors thinking about 2017.
So by bringing in Taiwan and speaking with the president of Taiwan over the phone, he's just mixing that up even further. Does it derail the relationship and the areas of trust that we do have with each other?
What's interesting to me was, 3 days after he had this conversation with the Taiwanese president, he appointed, of course, Xi Jinping's close friend, the governor of Iowa, as ambassador. So from that point of view, he is definitely sending mixed messages to Chinese, which I think is very clever. You think about it. Have you ever seen that movie, Rebel Without a Cause, with James Dean? In that famous scene, he was playing this game of chicken with this guy who was going to jump out of the car first, basically. Think about it. They're Chinese. You're playing. You're thinking about, well, I'm about to basically play this game with this guy who has a reputation being unpredictable, reckless, and even dangerous for that matter. I don't know if the Chinese are going to be so readily jump into the game with Trump. So I think Trump's unpredictability, in some sense, is going to help lower the probability of a crisis. But of course, we all know if there were to be a crisis, it's going to be the mother of all crises.
So there might be something to say for this strategy, this sort of, I forget the game theory term of it, but the wild strategy.
I think so. I think there's no question. I mean, in some sense, this is the same strategy he's using towards Carrier, towards Boeing, and so on and so forth, right? In some sense, because people don't know what he's going to do, and because people have no idea about his policy reaction function, so to speak, people are going to think twice. And so from that point, he might be able to achieve something that, without having to try too hard.
Trump aside, China is facing its own issues. Last week, we got the headline about limits on ATM withdrawals in Macau. That in itself, probably not a huge thing, but signifying perhaps a much deeper concern about the level of capital outflows. How bad is it right now for the country, and how much, what more do you expect to see on this front?
Joe, you just hit the nail on the head, right? You think about it. What's the difference between today and a year ago? A year ago, the Fed was about to hike rates, the dollar was going up, and the RMB collapsed, which basically brought about a collapse in emerging markets, global growth, and next thing you know, the Fed is no longer hiking rates. So can that happen again this time? The difference between this year, right now, versus a year ago, is that a year ago, this is before the RMB was included in the SDR. And China had to at least pretend that they were still trying to, essentially loosening capital controls. Now that, the RMB is including the SDR, they can afford to go out there and tighten controls without any consequences about the RMB being kicked out of SDR. So I think, as my real estate agent in New York would tell you, last year at this time, 20% of apartments sold over $2.5 million in New York City was sold to a Chinese person. Right now, it's 0. because, it's become more difficult to get your money out of China than to actually go to the moon right now. So I think from that point of view, if China is indeed successful in, basically containing this capital outflows, which I think you have to basically assume, I'm going to give them some benefit of doubt in terms of doing this. This is what's going to actually allow the U.S. story to sort of decouple from China, for the dollar to go up, U.S. rates to go up, and the U.S. economy to do better. So from that point of view, China's ability to crack down on capital outflows, it will be very, very important for Donald Trump's success in bringing off basically a good 2017.
Okay, so in addition to cracking down on capital outflows, what are China's next steps in 2017? They can't predict what Donald Trump is going to do next. So what do they do to proceed with what they need to do to reform the economy?
Well, first of all, you've got the Party Congress coming up at the end of next year.
Yes.
So they absolutely have to have something to show for. So I think from that point of view, I think downside risk Chinese economy is going to be more limited for that result, because they're going to be managing the economy even more closely than usual to make sure that, at least on paper, it looks all good and basically stable. I think the geopolitical sphere is more complicated. We are short. We've been recommending selling the Korean won. Mm-hmm. And the reason is because I think, that's where, if Donald Trump is not going to, maybe the Chinese are going to be nervous about, sticking it to Trump, but, however, you think, well, what does China really have as a trump card versus the U.S.? Well, North Korea.
North Korea, right.
I mean, even Donald Trump, or for that matter, Mad Dog Mathis, I think, are going to struggle to come up with, sort of out-of-box solution as far as basically North Korea is concerned. So I think, especially given the political crisis in South Korea, can the Korean Peninsula become the next flashpoint in this proxy conflict between Trump and China? I don't think you can basically rule that out. That's why I like basically buying out-of-money put on the Korean won.
All right, David Wu, head of global rates and currencies research at Bank of America Lynch. He'll be sticking with us as we talk about his other currency calls. You already heard one of them, the Korean won. This is Bloomberg. Glad you missed. David Wu, head of global rates and currencies research at Bank of America Merrill Lynch, is with us. And David Wu is bullish, super bullish, you would say, on the Mexican peso. Tell us why.
Yeah, because, first of all, everybody's short, right? Everybody's worried that, they're still short, and people are worried that Trump is going to be terrible for Mexico because of NAFTA. But let's think about this, right? If you look at the law, right, as president of the United States, he does have the right to throw NAFTA out of the window, flush it down the toilet, to rip it off. But he does not have the legal right to renegotiate his terms without congressional approval. And I'm telling you right now, forget about the Democrats, even Republicans in the Congress have no appetite to go down this path. So I would say they're not going to basically go near NAFTA with a 10-foot pole. And remember, Mexican export to the U.S. is 25% of Mexican GDP. From that point of view, U.S. economy really does accelerate to basically 3%. Mexico is going to be the biggest winner.
One factor that's traditionally driven the peso is oil. We got this oil rally thanks to OPEC. What's your takeaway on the significance of this agreement to cut production?
I think Russia's participation in the production cut is absolutely huge. It's unprecedented. I think, there are many different interpretations, but nevertheless, when we think about who's going to be the biggest winner, clearly it's going to be the U.S. Right? In that sense, Trump is actually quite lucky. It's almost like a welcome party, welcome present basically from OPEC and non-OPEC. Think about this. That means OPEC's cutting back on production means U.S. producers are going to be able to produce more at higher prices. So this is going to be bullish for U.S. GDP growth. It's going to be bullish for the dollar. There's no question about that.
Talk about the impact of the Russian ruble. Is it going to be bullish for the Russian ruble? We saw it rise today because of the rise in oil exports.
It's also one of the biggest this year.
We're very bullish on ruble. I think there are two emerging markets I like, Mexico and basically Russia. Russia also has the advantage that, right now, I think under Trump presidency, we're more likely to get a deal on Ukraine, which probably will lead to some sanction relief for Russia next year. So I think that is going to be additional, basically, bonus for Russia, not to mention the fact real rates in Russia is the highest within emerging markets.
Real quickly, I see here you have a call on the New Zealand dollar, the Kiwi. What do you see for them?
I think this is more of a technical call. I think, especially, I think this currency looks pretty expensive. I think in general, Kiwi and Aussie, I would say even Aussie is more expensive. If you're worried, as I said before, the whole fiscal stimulus, the whole infrastructure spending is not going to happen until much later this year. By the time U.S. construction spending starts to pick up, Chinese construction spending is going to slow. I think a lot of these commodities rallies not sustainable. Sell Aussie.
All right, David Wu, head of global rates and currencies research at Bank of America Merrill Lynch. Don't go anywhere, because next up we're going to be talking central bank policies from the Fed to the BOE to the ECB. This is Bloomberg.
I'm Nina Melendez. Let's get the first word news this afternoon. House Speaker Paul Ryan says the House Intelligence Committee will look into Russian cyber threats of the DNC and Hillary Clinton's presidential campaign. But he says any investigation should not, quote, cast doubt on the clear and decisive outcome of this election. Meanwhile, White House spokesman Josh Earnest had this to say about the probes.
You didn't need a security clearance. to figure out who benefited from malicious Russian cyber activity. The president-elect didn't call it into question. He called on Russia to hack his opponent. He called on Russia to hack Secretary Clinton.
Ernest called government intelligence officials patriots. In Italy, Paolo Gentiloni has been sworn in as Italian Prime Minister. The move came after Gentiloni submitted the lineup for his new government to President Sergio Mattarella. Economy Minister Pier Carlo Padoan will remain in his post as part of the new coalition government. Matteo Renzi had been serving as caretaker premier after he resigned last week when voters rejected his proposed constitutional reforms. And a manhunt is underway in France for 4 thieves who have stolen what could be more than $1 million in gold. The thieves took the gold from an armored truck on a major highway near Lyon and then set the vehicle on fire with the 2 drivers inside. Police say the drivers were rescued thanks to a tip from a witness. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nina Melendez. This is Bloomberg. Scarlett?
Thank you so much, Nina. Let's tell you what happened in the intervening 2 minutes while Nina was speaking. Boeing has boosted its quarterly dividend to $1.42 a share from $1.09. The consensus estimate was for $1.25, so this is a bigger than expected increase in its quarterly dividend. Also, Boeing setting a new $14 billion stock buyback program. Of course, it doesn't actually have to buy back $14 billion worth of stock, but this is an authorization to do so if it wants to. As for how equities closed, the Dow and the Russell 2000 finishing at all-time highs. The S&P 500 slipping 0.2%.
What'd you miss? Fed officials are set to meet in Washington this week to discuss rates for the first time since the U.S. election. While there's little doubt that the Fed will deliver a hike, investors will be closely watching to see how officials view the impact of a Trump presidency. Still with us is David Wu, Bank of America Merrill Lynch, head of global rates and currencies research. And joining us is Peter Fisher, senior lecturer at Dartmouth College's Tuck School of Business. Peter was the former head of fixed income portfolio management at BlackRock and former Undersecretary for Domestic Finance at the Treasury Department. Peter, thank you for joining us. Let's start with you. Everybody expects a hike, so we don't need to really talk about that. But then the question is, what do they indicate going forward, 2017 beyond? A lot of focus will be on those dots. How do you think they're going to position the ongoing hiking cycle after this meeting?
It's hard to say. My best guess is they're not going to try to incorporate any Trump fiscal plans, which look like they aren't quite there yet. But the Fed's going to have to reflect the fact that the economy is a little firmer now than it was in September. The labor market's a little tighter. The inflation measures have moved a little further. So it'll be interesting to see how much their inflation expectations and Fed funds path moves on them, even if they're probably not yet going to incorporate the Trump fiscal plans.
David, what do you think? You were saying earlier that there's some upside risk to growth estimates, growth consensus estimates here. How much does the Fed move up in its forecast for GDP?
I think here it's not a question of the Fed staff that's going to be forecasting GDP, but actually the people, who are going to be contributing to the whole consensus. I think, it'll be kind of strange for them not to basically apply some probability that some fiscal stimulus will get through, at least in terms of the individual who are going to be basically casting vote for the dots. So I think from that point of view, as I said before, the market is still pricing below the dots, and there's definitely going to be more upside.
It's interesting looking at the situation now this year versus where we were at the end of last year when they hiked. If we go inside the Bloomberg, this chart really demonstrates it nicely. On top, the white line is the U.S. Economic Surprise Index. And as you can see, this is for 2015. It was really heading down at the end of the year. If we look at this chart, you can see the purple line it's really shooting up. And along with the market going into the end of the year, very different vibe. Peter, do you think that unlike last year when they saw 4 hikes possibility and then they really had to ratchet it down, that we might see a real continuation this time due to strength in the economic cycle?
Yes, I think that's a possibility, but I think the hardest thing for the Fed is they really don't know where they're going to be a year or two from now. Right. They don't know how much this recovery we see is going to come through. They don't know how much on top of that the Trump administration is going to put and Congress is going to put. So I think what I'm looking for is what kind of hint we get about, does Janet Yellen know she's got to pull back from forward guidance? She's going to have to pull back from pretending she knows a point estimate on the Fed funds rate for 12 months from now, which she really doesn't know. And that uncertainty is going to come back to the markets. I think it's healthier. I think forward guidance has done its thing, and it's past its expiry date.
And we have a lot more to discuss on that forward guidance dilemma there for the Fed. But, David, I want to get your thoughts here, because it seems like central banks for the last couple of years drove the bus in terms of everything. They dictated how asset prices move. Now we're in a situation where fiscal policy is going to take center stage. Does monetary policy matter less to traders? I mean, as someone who advises on rates, where rates and currencies head, do we need to pay less attention to what the Fed says and does and more attention to what Donald Trump tweets?
Now, listen, even the Fed has been saying this for the last number of years. They kept rates super low only because fiscal policy was much too restrictive. So I'm sure they're more than happy to pass the baton off now to basically fiscal policy. I think in the fiscal dominant world, growth is going to matter a lot more than interest rates. So I think from that point of view, as Peter said, the Fed doesn't know. I mean, they don't even pretend to be able to see into the crystal ball. At the end of the day, growth is going to basically speak for the Fed and for basically and for the market. And I think we're going to go back to trading growth rather than basically interest rates, I think, going forward. Okay,
so that's the scene in the United States. If you look at the other big central banks, we're talking about Bank of Japan and European Central Bank, they're still on a path to, they're still in extraordinary easy monetary policy. You're looking at the balance sheets, and of course the Fed is in blue, and it's been pretty stable there, and it's actually inching down or trending down. The Bank of Japan is in purple, and it's come off a little bit. The white line here is the ECB, and they have extended their QE program, Joe.
David, it really feels like, in the U.S. there's a lot about what the fiscal picture is going to look like. In Europe, it really seems like not even fiscal so much as political. What's going to happen with the election in Italy? What's going to happen with the election in France? How do you see just sort of raw political risk, not even fiscal, sort of affecting the sort of economic situation that ultimately the ECB will be forced to reckon with?
I mean, there's a Chinese saying, when you're bitten by a snake once, you're afraid of ropes for the next 30 years. The market clearly was surprised by Trump and then by basically Brexit. So clearly the market doesn't want to make that same mistake again. But I think the market may overreact, because I'm not that worried about the German election. I'm not that worried about the Dutch election, because one thing we've known the last few years is that the right and the left in Europe, they hate the far right so much, they're going to do whatever it takes to keep them from power. I think a bigger issue is France. Because right now, the three center-left candidates, Macron, Val, and Mélenchon, their problems that they're equally popular. They're basically all campaigning on a very similar platform. They might cannibalize each other's, and then neither of them basically getting through in the second round. So you end up with basically Fillon and, Marine Le Pen. Right now, the market is sort of assuming that Fillon is going to wipe the floor with Le Pen. But is that a true, basically realistic assumption? Because think about this. Fillon is basically campaigning on firing 500,000 French civil servants. He wants to get rid of essentially the wealth tax for the rich. He wants to break the back of the unions. The last time the French elected someone like that into basic presidency was like 1873. I'm just saying, it's going to be difficult for him to get any votes from the left. And in the second round, this is going to be extremely, extremely crucial.
Right. I mean, this sets up an interesting situation for the ECB, Peter, because they have to keep in mind whatever policy they put in place has to kind of cover them for whatever election outcome happens in the Netherlands, in Germany, and in France.
Well, the ECB, it seems to me, is treading water here and hoping something turns up, preferably growth. But they really they're just treading water. That's the announcement they made. They're going to keep their plan going a little less, but a little longer. That's steady as she goes. They aren't likely going to get a fiscal boost big enough to be meaningful anywhere in Europe. It's just not going to happen. The politics, whatever the outcome of the election, it will be constricting. It's not the process of the election isn't going to be good for consumer confidence. So I think the ECB is just keeping its fingers crossed. And the same really with the Bank of Japan.
So your interpretation of the latest ECB decision was that it was basically the political approach to keeping the exact same policy, more or less?
Yes, exactly.
Keeping the peace, basically. Giving a little bit of everything to the hawks and the doves.
Yeah, I mean, it has its internal ramifications, but it has its external ones for Europe, because there's no fiscal rescue coming. Here in the U.S., much to the Fed's relief, there's going to be some fiscal policy to come around, but not in Japan and not in Europe.
Well, what about Japan, David? We talked a little bit earlier about Abenomics. Now that Trump is going to be president in the United States, does that give Abenomics another push? Does it breathe new life into that effort?
I think the election of Trump is about the best thing that could have happened to Abe and Kuroda, both of them. Because think about it this way, right? Only a month ago, we were talking about the fact that negative interest rates no longer effective. Japan was in a deep trouble because dollar yen been going down, because negative interest rates, nobody basically care about that anymore. And think about this, now with Trump, easier fiscal policy, high rates in the U.S., you see dollar yen going through the roof, Japanese, and this is why Japanese equity markets been one of the best performing. So they have actually, ironically, U.S. fiscal policy and Mr. Trump to actually to thank. But I think the issue here, which I think is a key issue here, is that the Bank of Japan, as you know, has gone a step beyond QE by pegging 10-year JGB at zero. Effectively, they become the central bank of the world. Because whenever rates go up anywhere else, you're going to see Japanese investors piling into all other basically foreign bond market. So in some sense, Bank of Japan, by pegging 10-year JGB at zero, is also capping long-term rates globally, including the U.S.
Is that sustainable, Peter, that Bank of Japan will be able to keep its long-term rates pegged like that, or will they have to relent at some point?
I think they're going to have to relent at some point. I mean, I actually interpreted the move they made in September to lock in the 10-year rate, to peg the 10-year rate, as a realization that over the coming years, they're going to have to let it back up. That they're just not going to have either the stamina to keep it there, nor do they really think they want to, because the negative rates didn't work. The flat yield curve hurt credit intermediation in Japan. So it's going to be something that they're going to be very gradual about. I think it's a lesson for other countries who've tried negative rates and extraordinary policies that unwinding these, you don't want your yield curve to jump too fast. And I think the Japanese, in this case, Kuroda, got ahead of it with his peg the long end so that he can manage it up over time.
So does dollar yen become a good litmus paper for U.S. policy or for Japanese policy? I mean, which one does it move more on?
Well, I think there's going to be more changes in the U.S., so I think it's U.S. change will drive that exchange rate because we sort of know what's coming inside Japan, but it's going to have a big impact, as David said.
I love that way you put it, that Bank of Japan is essentially going to become the world's central banker because everything becomes this de facto easing, money rushing to bond markets around the world. How big of an effect how big of a dampening effect on long-term yields in Europe, UK, the U.S. will that have ultimately?
Listen, I mean, this year alone, I think Japanese year to date bought something like $300 billion of foreign bonds. That's a lot of bonds. So, I mean, you're talking about the BOJ buying unlimited amount of JGB to keep 10-year JGB at zero, which is what they said in the last meeting, in order to allow Japanese investors to buy more foreign bonds. So you're talking about, I think it's about the marginal buyers. And there's no question that if you look at just in the last few weeks, I mean, since the backup in rates in the U.S., I think we've definitely seen very aggressive buying from Japan, especially investment-grade credit. I think long-term rates in the U.S. would have gone up a lot more than it did if it hadn't been for Japanese investors.
All right, David Wu, Bank of America Merrill Lynch, head of global rates and currencies research. Thank you so much for joining us. Peter Fisher is staying with us because we're going to talk about the problem with the Fed's forward guidance next, and also a little bit about dots as well. This is Bloomberg. What'd you miss? Is Fed forward guidance played out? Peter Fisher with the Tuck School of Business at Dartmouth is still with us, and he says perhaps it's time to get rid of the dot plot. So, of course, if you come inside the Bloomberg, this is the famous dots go. And you can see the green line is the median where the FOMC members have projected. The blue line is the market's projection, and as Joe has pointed out several times, they converge here in early 2017. Peter, when we talk about forward guidance, it's not just dots, is it? It's rhetoric. It's the communication policy that they have overall that has evolved over time to include dots.
Yes, the dots are sort of the firmest manifestation of this effort, which Bernanke really was firmest on and he first started talking about when he was first governor before he became chairman. Then during the crisis, it was a very powerful device to sort of assure everyone monetary policy would stay easy for a long time. And then the dot plot was a way of spreading that out, showing people how long we'll keep rates low. But it's really not credible that that's going to be maintained over time. Uncertainty is going to kick up here. That is, we'll have stimulus from the Trump administration. At some time, we'll have to worry about whether there's a recession or not over the coming years. This idea that we can put down exactly what we think the forward path of rates is out for several years, and that's going to be credible, it is going to expire. And so I don't expect Yellen to say anything about that itself, but I'm wondering if there won't be a hint somewhere, maybe tomorrow, day after tomorrow in a press conference, about that they realize widening uncertainty. So we can look in their forecasts this time, or maybe in 3 months' time. If the range of their forecasts is getting wider and wider and wider for GDP and inflation and the Fed funds rate, well, we know uncertainty is going wider and wider. So we're going to find less and less information from the dot plot.
There were a lot of monetary policy innovations that came about during the crisis. The dots are one of them. The press conferences was another innovation. But they obviously seem to have their drawbacks. Some would argue that the dots sort of may have forced them into a December hike because they had that dot out there. The press conference creates the impression that there are only 4 live meetings every year, even though they insist otherwise. Were these innovations valuable during the crisis period and have perhaps outlived their usefulness, or in retrospect did not fully serve what they attempted to serve even in a crisis period?
Well, I think the press conference is a useful device so the chair can speak to the world in the capacity representing the committee. I think it's a shame that we only think we're going to find something out about what the committee is going to do when the chair gives a speech away from the committee. I think we'd like to know that policy will change at committee meetings, not just little hints dropped in speeches. So I think the press conference is a good device for that. It has the limitation you say. I think the dot plot is a different problem because it anchors policy. It creates a kind of inertia in policy that I don't think is helpful, and that as uncertainty about the economy and the range of outcomes widens out, it's going to be particularly binding and awkward to pretend that this is helpful to spell out where we're going to be. When I ran the open market desk for the Fed years ago, it was a big deal to imagine we knew what was going to happen at the next meeting. No one had any idea what was going to happen 2 or 3 meetings yet. And no one would want to even bind their hands as to where we thought we'd be 2 or 3 meetings hence. So that's a healthier outcome, in a sense, to recognize the uncertainty that's natural in the economy.
That's interesting that you put it that way. I mean, I wonder if forward guidance is a blunt hammer. Is it more of a blunt hammer, or is it more of an open-ended device that lacks parameters and historical precedent?
Well, I think one thing that forward guidance was used for was the wealth effect, to try to pump up asset prices. You can read former Chairman Bernanke's speeches pretty clearly that he was trying to goose asset prices up, house prices and equity values.
So he gave specific numbers.
So he wanted to hold long-term rates down for a long time. Well, you might not always want to be doing that. It's a little more difficult now when we sort of want asset prices to go where they will and not just where the Fed is directing them to go. I think that's a business the Fed needs to get out of, and that's part of the exit problem they're having from extraordinary policy.
Real quickly, we've seen oil is having a massive year. In your view, I mean, obviously the Fed strips out headline and really looks at core, but in your view, how much does rising oil, rising gas prices play into inflation expectations and ultimately into real policy ramifications?
Well, of course, it's an important part, but what the Fed is going to look for, and the most important thing, is to see whether a rise in oil prices gets embedded elsewhere. So I think the public has misunderstood this, and the Fed hasn't been as articulate as it should be. The reason to look at core and then to look at CPI with energy in it, is to see whether big movements, volatile movements in commodity prices get embedded in non-energy prices. Like if you're eating out on the highway at a roadside restaurant, do that food away from home start reflecting higher energy prices? Now it's getting embedded in the psychology of inflation, so we should care about that. I think that's the sort of thing the Fed will be looking for.
All right, Peter Fisher, thank you so much. Peter Fisher from Dartmouth College's Tuck School of Business.
My pleasure.
And remember, on Wednesday, you'll want to be sure to watch our special coverage of the highly anticipated Fed decision that begins at 1 p.m. in New York on Bloomberg Television and Radio.
What do you miss? ExxonMobil CEO Rex Tillerson is said to be under consideration for U.S. Secretary of State. Last hour, BP Capital's Boone Pickens explained why Tillerson would be an excellent choice.
Tillerson, he's a worldwide personality, and to go from CEO of Exxon, I mean, he's leaving Exxon. He's off to a different part of his life.
Bloomberg politics reporter Kevin Cirilli joins us now from Washington. Kevin, two things. A, how confident does it look like Tillerson is going to be the pick? And B, how are these few days people had a chance to digest the news going over so far?
Well, the oil industry is really liking this, and the folks in the business community as well. I put that question directly to two senior Trump transition sources earlier today. They told me to expect an announcement sometime within the next 2 days about who this pick will be. Of course, Tillerson is right now the perceived front runner, but we'll have to wait and see when that final pick finally comes out.
Finally comes out. We're already hearing, though, that if he is chosen, Tillerson could have trouble being approved, winning confirmation from Congress, not just from Democrats, but from Republicans as well. John McCain, Marco Rubio.
This is where it gets interesting, is you have folks like Senators Rubio, Senators McCain, who have had a rocky relationship with Trump in the past, criticizing him for his perceived wranglings with Russia. So I would anticipate that right now the transition officials are doing everything they can to try to shore up support. You did see Trump give an interview and tweet out support for Tillerson. Clearly, this is someone whom he thinks highly of, but whether or not he would be able to get confirmed remains to be seen. Either way, a lot of intrigue around this pick is just the latest development in what has really become a fascinating journey for this Secretary of State pick.
Real quickly, do the headlines over the last few days about Russia and WikiLeaks and its reported preference of Donald Trump make the Tillerson pick even more difficult, given the lack of desire for just more Russia headlines?
Well, if there's one thing we know about Trump, it's he knows how to drive and manipulate the media. I would anticipate more tech headlines regarding the Russian involvement in the U.S. elections on Wednesday, when Donald Trump is set to meet with tech industry leaders in Trump Tower.
All right, Bloomberg Politics reporter Kevin Cirilli, thank you very much, and we'll be right back.
All right, it is Monday. When we look ahead to tomorrow, don't miss this. Coming out overnight, you've got China releasing its data for November industrial production.
And don't miss this. Tomorrow is the start of a two-day Federal Reserve meeting to discuss what could be the first interest rate hike since last year, and certainly since it'll be the first meeting since the presidential election. Then on Wednesday, we'll have special coverage beginning at 1 p.m. on television and radio of the announcement itself.
In the meantime, that is all for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.